Welcome to the Gray Report. I'm your host, Spencer Gray, and if you're a multifamily investor, active, passive, somewhere in the middle, I'm glad you're here because this is the YouTube show and podcast that we've designed especially for you, the investor, to bring you the best information right when you need to hear it to make some really smart and well-informed investing decisions. There's a lot of noise out there. We're trying to cut through that every single week by aggregating the best data and information. This week on the report, we have the National Rent Report from Yardi Matrix, a piece on hybrid work and the whole work from home environment by McKinsey. The National Association of Home Builders has a piece on home ownership in the United States. And the Harvard Joint Center for Housing Studies has a piece, 8 facts about investor activity in the single-family rental sector that you're going to want to know. Director of Communications and Marketing here at Great Capital, Dr. Matt Bosnagel is here once again, producing the show, keeping us honest, putting it all together. All right, let's get into it. All right, everyone, welcome back to the report. Thanks for being here. Matt.
Hello.
Hello. Interesting set of pieces today. Research, some articles, some familiar and some that we don't feature as frequently, but all really good sources today.
Yeah.
How do you feel? We start off every episode, it's more of like a gut check. How you feeling? Because this is why I'm asking, because, this is a little bit of inside scoop, but, before we do this, you're back in the laboratory really for the last week, but you're going over every report, every article that's coming out. You're reading through it, you're analyzing it, you're making notes on it, and you're picking out the best couple pieces that are like, okay, investors need to know this.
Yeah.
And so I'm always curious what's going on in Matt Bosnagel's brain, like synthesizing, like what's going on in the housing industry this week. What's the thing that's going on? What's top of mind?
In terms of like sentiment, I'm thinking things are going a lot smoother than maybe people were thinking like a month ago. Last week was okay, and like I just keep hearing good news. It's not scary good news. It's just smooth. It's a normal week in a year where we haven't had much normal. A little bit of bad, a little bit of good, but this is I'm getting comfortable and a little less anxious in a way that I wasn't for a long time. I mentioned this earlier, and I'm going to probably reference it in my notes, but Goldman Sachs took their recession prediction to 20%. There's a lot of people that are getting a little bit more optimistic, and the reason why I'm kind of optimistic is because things are not great enough where it's like, oh, well, we got something not under control, but we'll kind of discuss that. And in the apartment market, it's like gravity exists. There are, supply. If more supply is going to hurt demand a little bit sometimes, but also for the places that don't get half supply, rent's going great. And it's just like the rules are applying now.
Yeah.
It's a lot more smooth, and smooth is consistent too. So it may not have, gangbusters rent growth, but it's something you can predict. And hopefully it's something that investors can kind of plot things out, because I'm not seeing any sharp right turns.
No, definitely not any sharp right turns. I mean, we are still, I think, experiencing a little bit of the correction, which is like a correcting to normalization after, 2021, which had crazy rent growth, to, the first half of 22 was strong, but then, things just did take a right turn downwards in the second half of 22 and in the first quarter of 2023. We're doing our finishing our Q2 reports. Also, Q2 ended, last month at the end of June. So we deliver those, at the end of July, once we get all our financials, do our analysis, put everything together, make it look good. And we're going through reviewing those. I'm doing video reports, and the first quarter was rough in terms of demand and expense growth. It was like a double whammy. We saw we weren't leasing as many as we wanted to. Traffic was down, but then our expenses had exploded. Whether it's utilities increasing, having to pay more to get the right people on site, just materials. And we were fortunately able to make a lot of really good changes, and so our expenses are materially down, in some cases like 30% quarter over quarter.
Okay.
But and again, these are these are anecdotes, but where rent growth and all of that is positive, and it is more like a normal year that we would have seen in the last decade or so of moderate, low single digit growth. 3% rent growth, 4%. We're in the 3s and 4s, which is like normal.
Yeah.
But compared to the last, again, year and a half ago, it's like it seems like nothing. And then expenses, are there. I think they're leveling off and normalizing, and we are and others are controlling them. But there's a sense that the margins have just gotten thinner. And the other difficulty is, if you're on a floating rate loan, you have these rate cap escrows that you're also having to continue to pay for, which is a major drag on free cash flow. It's your money. It's going into escrow, but, it's not money that you can distribute. And we've got a property that, we had high expenses. We've made major improvements. Things are going in the right direction, but, we still we're putting a lot of cash into these rate cap escrows, which, glad we've got it, but it's a little frustrating, but it's not showing up, kind of on the true bottom line, what we can distribute. Yeah. So, there's one deal where we're missing, our pro forma distributions, not necessarily on property performance, but because of these rate caps, escrows. And so, we're like, well, we just have to overperform to be able to get back to, where we want to be. Yeah. So so things are good, but I would say they're, and we look at we'll look at the Yardi data, but things are a little bit, they are normal, but it's like a soft normal. Yeah.
That's kind of been the story. People say moderating. I don't like to say cool down. I do think that moderating implies it's a reaction from an extreme, and the challenge, and hopefully, because this is a long-term investment, there's enough of investors have experienced the high points from the past 2 years where it kind of cushion the blow. But if you time it at the wrong moment, then this is not a great.
No, it's not. And it's time that if you haven't battened down the hatches, you're really in a tough spot, and it's going to be kind of trudging through, slogging through, the thick muck until we get our footing a little bit, and we're starting to feel it. But it's going to be work, and they're all slow moving, beasts, and it doesn't happen overnight. Now it can happen over a quarter or two, but we're actually in some markets we're actually seeing slow down now compared to like the winter. It's strange. In a couple markets we're seeing things cool off. We don't know. It's the middle of the summer. It's 4th of July a couple weeks ago or what, but we're not. I don't think we're out of the woods. Like we're not seeing like negative growth by any means, but we're also not having a gangbuster summer, which no one really ever thought we were.
I'm going to be interested to see how seasonal rent growth is going to be for 2023. Because if it was all out of whack for the past 2 to 3 years, and so this could keep there could be more rent growth in the latter half.
Yeah, the shockwaves and the reverberations, we're getting back to normal, but we still are feeling those. And so it's not going to look like a complete normal season, but we're getting closer to at least mimicking it. Yep. Well, Matt, let's jump into the Yardi Matrix report, the National Multifamily Report. And we feature these quite a bit. They really do a nice job of putting these together. And, I am noticing, Matt, Indianapolis is not on the cover image. That means Indianapolis has lost the spot for top rent growth, which is not surprising. Because following a little more granular can only be on top for so long. Sorry,
give us a spotlight. That's fine.
Yeah, exactly.
Yeah, top line numbers, year-over-year rent growth is at 1.8%, and month-over-month is at 0.4%, which is well in line, actually, from the reporting from other organizations. I was crunching the numbers last night, and we follow a number of rent growth trackers, and the average month-over-month rent growth has increased each consecutive month of 2023, but it's still just not at the level as it typically is. Top markets for year-over-year rent growth, I'll kind of give the top 4 here, is New Jersey, New York, Indianapolis, and Chicago. These top 4 are the only markets to beat the 10-year rent growth average of 4.7. Now, that 4.7 is elevated due to the massive rent growth we experienced during the pandemic. So these 4 markets are doing very well, I think, to beat that boosted number. For more of the moment data, the monthly rent growth leaders are New York, Chicago, Columbus, and Boston. Now, Columbus, they've swapped out a few of the markets in Yardi Matrix. So they're including Columbus. I think they've excluded Kansas City. They just shaken up things a little bit. And Columbus is worth noting because it's the third highest in month-over-month rent growth. And all of them saw about 1% of rent growth from May to June, give or take. For the monthly and yearly figures, the story really continues to be one where big cities on the East Coast are bouncing back, and the yearly figure, where big cities on the East Coast are bouncing back, the Midwest is doing consistently strong, and there is this kind of general region. There's a little bit more regionality than you think. Northeast is doing pretty good.
Yeah.
West is doing pretty good. Some of the Sun Belt not doing great. Miami is still doing,
doing its thing.
Still doing its thing. I did want to note Miami is one of the most interesting things here is their lifestyle asset class. They are the third lowest rent growth. This is for month over month and year over year actually as well.
You think that's like a base effect?
So
like there were already high rents in Miami?
Maybe, but then they're the number one for renters by necessity.
Yeah, that's interesting.
This huge bifurcation of rent growth really suggests that the gap between the high-end apartments and the low-end apartments in Miami is closing.
Well, and again, is that because of demand? They'd already raised rents so much in Miami. You know, they were building new apartments, delivering new apartments at incredibly high rents.
Yeah.
Haven't been delivering as many, and so they're not getting the growth. But at the same time, all those older properties at lower rents are seeing increases.
Now that is like a perfect example of what could happen, or maybe what happens a lot of times when new apartments come in. They're the new ones. They're the nice ones.
Yeah. And what do? If you're a competitor that's maybe not as nice, but sort of close, you're like, that's the new high water mark. And you're like, well, let's just bridge the gap. We're charging $1,000. They're charging $2,000. Well, okay. Obviously we can't charge $2,000 for the same unit, but maybe we fix things up a little bit, make it a little bit nicer, and we charge $1,500. Is that value? Is that different? Does that make sense? Are we making the right value proposition? You have to know right where that line is. But it's like you can always narrow the gap because people are always looking for a value and a discount. And if nothing else in between, you can find a really nice niche.
Exactly. And that's the challenge. It also illustrates the challenge right now is everyone's clamoring for more affordable apartments. And it's just hard to convince people to build something that is, affordable or like workforce housing. These kind of, you can't, like the ones that are like maybe built in 1980s. You can't just like magically make that appear. And because all the ones that are newly built are probably going to be the nicer ones. It's just hard. Yeah. Unless it's maybe like government subsidy, but that's just in a whole nother category. It's a spotty, you can't address that problem as effectively as the market is having a difficult time to address that problem.
Yeah, it's figuring it out.
Yeah.
Looks like on lease renewals are staying really pretty strong. The headline here is transacted rents, renewal rates resist slowdown. So we're seeing still some pretty strong renewal figures. I mean, if you'll remember, prior to COVID, the average renewal rate or retention rate in the U.S. was around 50%. And people kind of were staying put longer. And so that pushed up closer to 60%. And many markets were still in the high 50s, 60% range. I mean, Miami, Matt, it's 70%, which is incredible. But people are still, staying put. And for a while, it was because, if you rented somewhere else, that you were going to get hit with full market and the rent was up a lot more. And so they're like, we want to save some money staying put. But, as the market has gotten a little less tight and there's been a little bit more favor to the renter and a little bit more, negotiating power. There's been some more concessions. Anecdotally, I would think that this number would start to really go down, which is why, they're saying, it's resisting the slowdown. Still, rates are up pretty well over the long-term average.
Yeah. I mean, it said, what is it? New Jersey, I guess, at 82.3%. had the highest renewal rate, reflecting the lack of available options as occupancy rates are above 97%.
Yeah. Not going to move. There's nowhere to go.
Yeah. And another thing worth noting, and I may have noted this earlier, is they have 95% for occupancy. It's fairly steady. It's still, it's not as high as it was, but it is not, it's been steadily falling down since that high for so long that to see this kind of steady, that's nice.
Yeah.
Again, smooth. Smooth is good.
Smooth is good. No, we would like to be able to predict things. They're also noting here on the report, Matt, the supply and demand demographics. Borrowers eschew high cost mortgages.
Mm-hmm.
Did I pronounce that correctly?
Yeah,
Eschew. Cost of debt has jumped significantly since the spring of 2022 when the Fed started increasing policy rates. Lenders, including Fannie and Freddie, have seen mortgage volumes plunge as a result of a wide market bid-ask spread. Sound familiar? And then more borrowers prefer 5-year fixed-rate loans that can be prepaid after 3 years to provide flexibility when rates are expected to decline.
Hey,
makes sense.
Hey, here's a real risk. You want to get a floating rate now, just ride them on the way while it gets lower.
Don't tempt us, Matt. No, it's a serious argument. I'll give you an example of a deal we're looking at. Our conclusion was the best execution for this deal would be a bridge loan. Now, I think it's like surprising people hear me saying that because we're talking about the kind of the danger of bridge loans over the last year. But we used to use bridge loans all the time, and they can be an excellent tool. Yeah. Just like any tool, you can use it for good, bad purposes, dangerous, positive, whatever. And the specifics on this deal is it was coming out of a decontrol, which the rents, it was an affordable property that had lost its affordability, where it had been transitioned out of affordability. Now it's market rate, but the rents were still all at the affordable rents. And so, you're only getting your loan proceeds based on what the actual, the receipts are and what the actual income is of that property. Now, that, you can cycle through those leases and get those rents up in probably a year or two. But, the loan proceeds that you'd be able to get today based on the current income, because, lending now is all income restricted, debt service coverage ratio restricted, not loan to value or LTV restrictions. It used to be, it's like, whatever the value, you can borrow up to 75%. Now it's like, no, you need to make sure we're clearing this 1.25.
Okay, so it's not DSCR. They look at how much money you're bringing in, or how much the value is, and they kind of have that. It's their prerogative.
Yeah, it's usually most things must be true. The loan must not exceed. It basically will have a max LTV, and so that you can go up to this max loan to value, but it also has to meet this debt service coverage ratio requirement. So you still need to be making 25% over just the minimum to cover the debt service. Yeah. And then if you're doing that, then we'll lend up to whatever, we hit this max loan to value. And so in the past, a lot of operators and buyers were, borrowing at around 75% loan to value, not a problem. You can clear your DSCR. Maybe you clear your DSCR at 1.26 or 1.3 or, whatever it was. And, that's what your loan proceeds were based on, your leverage, and also it's all risk, the higher leverage, the bank will give you different terms, whether you have lower leverage. So if you have lower leverage, typically they'll give you a little bit of better spread. They give you more years of interest only. Okay. So there's a couple differences between kind of where you fall in that risk spectrum when it comes to the, your lender and what they'll give you. And so it's been DSCR constrained rather than loan to value.
Yeah, that's what the banks in general are really looking at, that DSCR.
They always are. They always have been, but it's been the issue now because so you'd say, be like, all right, we're buying it for this price, put a 75%. You used to be able to just kind of assume you wouldn't. I mean, it wouldn't be difficult to hit the DSCR because we were buying at reasonable cap rates.
There you go.
But now everyone's buying at low cap rates. That makes it difficult to hit that DSCR. And this is where there's going to be some business plans that aren't going to be doing that well because we know just the growth that you had to assume. Everyone was buying at these low cap rates. Yeah. Or almost everybody. I think, we were some of the few that really, we drew a line in the sand and said no negative leverage. Other groups did the same thing, but we were in the minority. And, you hear this all the time. It's a bit like, we create the positive leverage because we're going to raise rents. We're going to execute our business plan. Yeah. And that's definitely the case. Like we wouldn't be in business if we were just going to buy it and leave it and not do anything. You always want to improve. The way you get a higher rate of return is not just by, assuming that the asset is going to appreciate, but we're going to force appreciation by increasing net operating income, either by raising the income or reducing expenses, or ideally both.
But if I'm a banker, that sounds a lot like promises. Yeah.
Well, that's
okay. You can tell me.
And some lenders will lend to you based on your pro forma, especially kind of in the bridge space or debt fund space. They have more flexibility. But if you go to any of the agencies, it's based on what you're collecting. What your T3 says, what your T12 says.
Like not just what you're expecting, but what.
No, I mean you have to prove it out, especially now. I mean, again, we've talked about this week after week. It's credit is not loosening.
Yeah,
credit is tightening, and so these banks want to make sure that the loans that they are issuing are good loans, good borrowers, and not just It's not business as it was in 2021.
Yeah, which is interesting. So I wonder, is there like an opening here? Because they talk about how the low volume for Fannie and Freddie means that they're missing their target for how much they need to lend.
Yeah.
And does that mean that there are some people that could get like a deal, or that they will make an arrangement in order to meet the target?
I believe we'll have to confirm this. I've been told that Fannie and Freddie have been told that don't worry as much about your quotas or your caps, because the concern is always that if they don't lend if they miss those, they'll get their quotas, the caps reduced. They won't have as much to borrow to lend. Sorry.
Yeah.
If you remember, I think it was back in 2019. Fannie and Freddie were at those caps. They ran into those caps. Yeah. They didn't have any more money to lend. And spreads blew out. It was really frustrating. People had to look at alternative, financing measures. It wasn't a long period of time. We have the opposite problem now, where they had the caps increased where they can lend, and I forget what the caps are for 2023, but they're not
$75 billion or something.
Okay, that sounds about right. That's about what I think. Because it was increased to $70 billion a piece a couple years ago. Yeah, Fannie Mae and Freddie Mac won't meet allocations. Now it's $75 billion again. I believe that's a piece. If rates remain at 6.25 to 6.5, I don't see us getting to $75 billion. Not even close. One GSE executive said at the recent CRE Finance Council annual conference, without transaction activity, it's hard to see volumes get anywhere near $70 billion. Along those lines, the agencies changed the production mandate for mission-driven, affordable, and green loans to half of originations as opposed to a specific number of units. So that means, again, green emission, there's an environmental component, making properties more efficient, low flows, LEDs. Mission is, targeting, the moderate income band. I forget what percentage of AMI, but, not super luxury. You're providing housing that's kind of, again, close to that median income range. And if you fall in that category, again, it's not like subsidized, it's not like affordable housing. You're providing housing to a certain income range of the current rents are, you can get some better loan terms, such as maybe a 35-year amortization if the agencies are still providing that. I've gotten mixed messaging that they are slowing that down. Then I'm also hearing that if it's a true mission deal, they will still be open to it. But then also interest only and your spread, again, if green or mission, they can get a little bit better on their spread, which a spread is like the profit, the interest they're going to charge over the base rate. So, typically people are borrowing either, on a 5, 7, 10-year term. So the loan is based on the 5, 7, 10-year treasury plus a certain spread that the lender is trying to make over that, account for their risk. So right now it's kind of, mid 200 to, call it 220 to 280 spread, 300 point spread right now. And so, but they've got some flexibility with that spread. And that's where you're asking Matt of hey, they make it desperate. So people get a deal. The deal would come in the spread. Okay. Maybe the amortization, maybe the IO, but the spread is really where they can help. If it goes from 250 to 280, well, that's, that's 0.3%, of your rate that goes down. That can be meaningful because when your rate goes down, that affects your debt service coverage ratio. Less debt service that you have to pay. Therefore, you can get a better ratio, which means you can get more proceeds, which then, more proceeds is more debt service. But, so it's a little bit of a, cyclical chicken and the egg, but the better that you do, the more proceeds, better loan value.
I don't run the Excel things, but it's crazy how much the numbers go up if you change a small amount of the debt.
Yeah. Yeah. We've got other people to run the Excel things.
Yes. Gratefully, thankfully so.
Yeah. All right. Just real quick, man, employment and supply trends. Again, this is looking into the future. Let's see where things are going. Maybe, look at some acquisition targets.
It doesn't seem like much has changed specifically, but I did want to pull out Indianapolis has a great, as great prospects, really great rent growth, really pretty decent job growth, really promising for investors, completions as a percentage of total. So not a whole lot of supply coming online. And then in the next page, you look at the income to rent to income levels, or I'm sorry, it may have been the web. Either way, it's really cheap to live in Indianapolis. There's not a lot of apartments coming online, and there's really just all of these factors are support the idea that
they don't have rent income ratios.
Oh no, it was the page before.
Sorry. I'll find it for everybody just so they can look at it. But yeah, no, I mean, Matt, we talk. I mean, we don't need. People have heard us talk about why we like Indianapolis a lot, but I mean, you don't have that much supply coming online, but the rents are growing, the jobs are growing, and it's still affordable, which means that there is room to grow. I mean, of this major market list of, what percentage of your income is going to rent, New York tops the list. Renters by necessity are paying, Matt, 44%. I mean, it's horrible. Rent control seems like it's really working out for the Empire State, or the Big Apple. San Diego, same story, 38% renters by necessity. I mean, that's just a travesty. It's too bad. LA, I mean, horrible. But go down to the bottom of the list. I mean, you've got Indianapolis. It's surprising to see Austin there as well. But I mean, Indianapolis, for renters by necessity, 27%. That could ideally be even lower. Anything over 30% is considered rent burdened. But it's a market that it's not rent burdened. Most of these other markets are in the 30s.
Yeah.
But then if you are, lifestyle units, more expensive stuff, it's 25% for Indianapolis. Overall, 26% income to rent ratio, which is, again, pretty darn good. And again, one of the reasons why people are moving around is affordability,
and that plays a little bit into the McKinsey report.
Let's hop over,
that it is this idea of the title of this McKinsey report is Empty Spaces and Hybrid Places: The Pandemic's Lasting Impact on Real Estate. I'm glad I caught this. This came in last week. McKinsey casts a large shadow as the oldest and largest of the big three consulting firms, and their analysis, I think it deserves some coverage here. If not for the quality of the material itself, then for the business decisions that it is generating as McKinsey consultants advise companies and governments.
Do you think how many consultants they had involved in this image?
I don't know.
Is this a what is this? Is this it's not probably not AI. What is this?
It looks almost too perfect to be real, but
it's not. It's definitely not real. Anyway, but I mean, they've got the live walls and this guy in the office having fun. What is this about? Is this the live work play?
This is a lively commercial. This is a lively commercial center where a hybrid environment of office, apartment, and retail is creating something that is more resilient than a monoculture of office buildings.
Oh, so we're looking into the future. I see. Yeah. Matt, you got it down. So they've got their what store? Is this a bookstore? Is this a painting store? Abstract art? Jackson Pollock store? Is that what this is?
It looks like they've got some kind of brewery next to
Cafe
it.
Moon, fine, yeah.
Cafe. In the background, there's balconies and apartments. They're living, they're buying, shopping, working, everything's there.
All very green. We're in our green spaces. And this guy's getting some done in the boardroom up there. Looks like he might be throwing a rock at the window, maybe trying to break out.
Yeah.
But so McKinsey, they're obviously so smart. People pay them stupid money for their fancy PowerPoint presentations.
Shaping nations. But really,
what do they have to say?
So good. We don't really have to actually look very far for the thrust of their article. It's in the title. Empty spaces.
Do you think people are paying like hundreds of thousands of dollars basically for this information that they could just read in this report?
Yes.
There are companies that are like, tell us when you do on hybrid work. Mm-hmm. And they're like, sure, we'll take your business. And then we've got this PDF you can just read.
I don't trust a PDF. I want you to come in here in person.
I need to see the slide deck.
Yeah. There's so many bright-eyed, very well qualified consultants that are, I think, in regurgitating a lot of the insights here. And again, their point is empty spaces, those are the empty office spaces, and hybrid places, those are hybrid work places.
So this is an empty office?
Yeah,
dear Matt.
Getting ready to become maybe something else. And that's one of their points actually. And I love they do actually come out against office to multifamily conversions, which is great. But their at a glance summary is really helpful. Just to kind of get a general idea of everything, and I'm kind of going to give my response here. So they say hybrid work is here to stay. It's not the first time we've heard something like this is a more useful as like a solid claim. We're at a point where we're seeing louder voices calling people back to the office, and I'm sure McKinsey has heard their fair share of bosses saying the same thing. The fact that they're taking a stand saying...
What do you all think about this, McKinsey?
Yeah. And they're not only saying that people are not coming back to the office, their projections are, 19% down by 2030 in their moderate projection and 30% in their severe projection. So it's going to last. The hybrid work is here to stay.
But it's maybe a new form where we've thought about it, but hybrid work's been here for a long time. It's now a new reality and a new standard, it's less of a unique situation, I guess.
Mm-hmm. Yeah, I think that and maybe that would be a better way is like this increase in hybrid work isn't going to erode at the level that people may have thought or that people are going for, which I think is a pretty strong stance to take, because it did seem like there's growing voices. And I think there's an outside shot that office demand may come back a little bit more, but I think their point is still valid. We've seen a cutoff in office demand that will never come back.
Yeah.
The ripple effects is their next point. Really good point. And their summary comments really focus on declining downtown retail markets, but I think it goes beyond retail for sure. And some of their detailed commentary does talk about other places, but really they're focusing on retail spaces. And that's their next point, is that demand for office and retail space in superstar cities will remain below pre-pandemic levels.
So you don't have people at the office taking a break, shopping.
They're not going to shop. They're not going to go to the restaurants, and maybe hotels. I would think hotels, convention centers, those demand may be lower. Although
that are more focused on business travel.
Maybe. I don't know.
I mean, obviously the pandemic's a big hit to that, and it has not. It's come back, but not the same level. Because I mean, people do want to go out, meet clients, meet partners, but there's still a lot of meetings that are done virtually now. I mean, the pre-pandemic video calls, it's hard to realize they weren't very common. Yeah. I mean, I remember being on kind of the first few Zoom calls just before the pandemic, and they weren't standard by any stretch of the imagination. It would have been a little bit. It would have been novel to a lot of people prior to the pandemic to be like, hey, let's hop on a video conference together. For our first meeting, let's hop on a video conference.
Yeah.
It would have been like a little much. It would have been like, let's just have a call.
Yeah.
Let's get together for coffee. But now it's like, no, but now it's kind of what is expected.
Yeah. It did supercharge a lot of things, and they got a lot of, systems in place that wouldn't, that probably we wouldn't be where we are right now. I think that when you're looking at the real estate, I think that everything seems to follow the fact that all these people aren't gathering in an office, whether they're taking on more video calls or whatever. They're not gathering in the office, so not going to the surrounding area. This whole space itself is devoid of activity, devoid of foot traffic. And they do talk about how online sales have cut into retail. I think it's just a lot of this has got to be foot traffic. You're not in that space. I think I would 99% of the time, I'd rather go into a store than order something online.
Yeah.
Especially if I'm close to it. So there's a little bit of a chicken and the egg. Maybe they did it more online because they weren't downtown as much. But they get to really what they talk about the most, and I think what's most interesting here is what makes a downtown succeed, what makes it not succeed, and how can we kind of force the success.
Yeah.
They talk about how real estate is local, which I'm going to give them a pass to that, because not everyone is. McKinsey's writing to an audience that maybe not real estate professionals, that they don't know that real estate is locally diverse. But their answer is a little more interesting. They're saying that cities and buildings can adapt and thrive by taking hybrid approaches. So mixed use buildings, and maybe we know about mixed buildings.
Yeah.
In multi-use office and real estate, and retail space, those are noted in the summary. But I want to kind of drill down to their specific comments where they talk about not only just mixed use, but a building, something where a building can be retail for one tenant, and then next it's apartments or an office. Something where you build a new building that is more flexible to different kind of tenants.
Yeah.
Rather than, it is a dedicated office building. It is a dedicated this.
And I think that's started to really happen. I know a lot of developers who are office developers who are building a lot of optionality into the design. They're like, okay, let's build this office building, but knowing the challenges of like the office to multifamily conversions today, let's build this. But like, what if we wanted this to be a living space, an apartment? Could it be converted into an apartment? And let's say even like halfway through, we're not getting any interest in our office, we can pivot, do a hard pivot. And the same thing with, retail or, whatever it is. Like, how do we have flexibility?
Yeah. And it's like, they're probably more expensive on the front end to build that building that can fill many uses, but they're seeing the risk of, emptiness.
Yeah.
Which is probably a lot more, a lot more key.
And I'm sure that'll smooth out over time when we have a better understanding of what the demand is for office. But like right now, it's this is what I know how to build, but I don't know if anybody wants it. So like, it's cases where like the deal was already in, the development was already entitled, or like going down the road, and they're like, I don't know if we, should do it this way. Like we're already kind of pregnant with the idea and the project, but like, can we make some changes so where we can pivot if we need to? Like, how do we turn this thing into condos? Add more retail.
I think it's smart. I think that there are some buildings probably where it does just make a whole lot more sense to build it for a single particular use, but not only on the building level. And I do like this point though. They do note office to multifamily conversions, and they kind of put the kibosh on it.
Yeah.
While their sample size is limited to superstar cities, they find that if all the excess office space were converted to housing, you would only increase housing supply in these cities by 2.6 or less, often much less. That's a powerful point. Even if we had the means to convert all of these empty office spaces, which we don't, and even if all these office spaces were able to be converted into apartments, which they're not, would still add a strikingly small amount of existing housing supply, and almost more than we build more apartments in a year.
But maybe it's true, but it's not. I don't know if it's the goal, or I don't think anyone is saying that office to multifamily conversion is going to be the silver bullet to solve like the housing problem.
Yeah,
I think we're saying that it could potentially help.
Mm-hmm.
Obviously it's gonna, and it doesn't change the picture, but 2 to 3%. That is something.
Yeah, that's true.
That is like,
that is a lot
for a a kind of a steady growth market. That'd be a normal year. And so if you're adding additional supply, it could increase it by a third. Easily by a third. So it's not nothing.
True.
But bottom line, it's not a fix. It's not the solution for the housing crisis. It could be.
Good point. Very good point.
A solution, or a part of the solution for the question: what are we going to do with all this space? And I think that's really what cities and owners, investors are grappling with. Is we have these buildings. What do we do? They're littering our downtown.
Mm-hmm. So I think that you're using the word space is really key here. It's not necessarily, maybe the solution isn't a building level thing. And instead of converting office to apartments, they're calling for a more varied mix, like at the neighborhood level. Yes, they do argue for new buildings to be reused, but the most compelling point is they're making, and they give examples of cities that were the least effective were ones where there is a mix of retail, of residential, and of office and workplaces all in the same place. This would take a lot in order to affect this change and bring in, a more varied presence.
Now it would be the time to do it, though.
Yeah, I totally think, and you could do this on a neighborhood by neighborhood level. Mm-hmm. You wouldn't have to by fiat change everything. It's just if it works here, but it would take effort by local governments, businesses, resident stakeholders for zoning. But again, if your alternative is these empty office spaces, I don't see why that's not going to light a fire under some people.
And I think there's an article about I forget which city it was, but taking, I think it was Boston. You see the article? I think Andrew sent it to us.
I'll have to look at it.
It looks like Boston may be offering some major incentives, like a big break on your property taxes up to 75% for office to multifamily conversions, because the economics don't really make sense. So they say, but we got to do something with these, and whether it's feasible or not, because I'm sure the city government leaders aren't really digging at how feasible it is. It's an idea, and let's throw it out here, see if anybody wants to do it. But there needs to be some economic incentive to make most of these deals pencil, because they just don't pencil economically. When you look at it, it'd be better just to knock the whole building down most of the time.
Yeah.
So it'll be, I think some cities are going to be, get really aggressive on it. I can see some cities, buying certain assets out just outright, especially when they start to fall into special servicing and foreclosure, which is, that's the whole other part of the office story, is that values are down 30, 40, 50%. As their leases turn over, they're going to continue to turn over. They're either going to empty out, or the rates are going to go down.
Yeah.
And the loans are coming due. And so there's a lot of issues that's going to take place. And we reported on last episodes, it's going to be a couple of years as all of this continues to roll over, more and more kind of issues and distress. And what is the plan when this starts piling up and you've got, whole blocks of, distressed, real estate, that it's going to be, it can be a process to go through that.
Yeah.
Is a city going to come in and say, we want to either partner with a private group, or we're just going to come in here and buy all of this pennies on the dollar, and so we can just control the process, which, there are going to be some poor unintended consequences, and maybe the redevelopment slows down because the cities get in the way. Hopefully it's the right balance of, public-private partnerships that speed things up. And get rid of red tape, but each city's going to be different.
I'd like kind of a carrot rather than a stick. I think that rezoning could really open up a lot of interesting options for people. And again, it's like it's the same thing for, I'm sure, for the building level and for the neighborhood level. If you're looking for flexibility, it's going to probably cost a little bit more upfront. It's not going to be the most efficient solution, but it may be the most resilient solution.
Yeah.
And again, like they keep really leaning on the word hybrid here, but to me, it sounds a whole lot like diversification. It's like, you want to diversify your investments, so if one company goes down and you're only invested in that, then you're screwed.
Yeah, it's really, this piece is getting to a much larger point beyond like the future of hybrid work, and are people are going to work hybridly or not. It gets into, and I don't know, maybe this was like scope creep of the piece, but it's like, what our conclusion is, we're going to have to completely redesign all the cities. That's basically what they're saying.
Heck yeah.
They're like, that's how maybe this is the lead magnet to city planners, not necessarily are the business owners, how the hybrid work. It's the city planners are like McKinsey things. We need to completely redesign everything, how we run the cities. Let's all, put them on whatever size retainer.
I'm glad that you settled on that little, those quadrants. I don't know what this little map here, where it has the factors that they think lead to a particular market being vulnerable to this hybrid situation. Now they're on one level, there's the y-axis, there's a business mix where if you have more workers in the knowledge economy, more large firms, more ratio of inbound commuters to residents, and cultural acceptance of remote work and necessary technology is a little lower, then that is going to make you a little more vulnerable. Now, on the other hand, on this x-axis, if you have more residences and stores, more green space, this flatter price gradient, then maybe you're going to survive. But if you have more office buildings, maybe it's just only office buildings and there's less green space, a little bit more dense, then it's going to be a little tougher. That was another point that they made too, is the denser cities had a little bit tougher of a go.
It's interesting just looking at, these factors relative to how these cities have been performing from a multifamily side.
Yeah.
And, I'm not as tied into how London is performing, but San Francisco has been, a big loser, in kind of just as a city recently. It's a really sad story, and we don't, have the time to get into it, but really been suffering, from the multifamily investor standpoint. New York City, there's all kind of challenges and problems with New York City, but it's really, unlike San Francisco, really bounced back after the pandemic. And we're seeing in general, the Northeast has been doing pretty well in terms of, performance. And so I think some of that's correlated, not totally, but, when I see, one type of city has more residences and stores, flatter prices, more green space versus more office buildings, steeper prices and less green space.
Yeah, I'm not sure about that.
San Francisco's got a lot of green space. I know what they're talking, but I don't know. I don't have the numbers in front of me on that one in particular. Okay, Matt, let's move on to, where do you want to go? National Association of Home Builders, talk about home ownership, or the Harvard Joint Center for Housing Studies?
Let's talk about this National Association of Home Builders. It's a short
NAHOB.
Really a map, more like it, but they have some insights here. I think there's fertile ground really in examining home ownership patterns. And at a glance, if you look at what they have here is a map. It's kind of a heat map that takes every single county in the country, and it shows you what the home ownership rate for them is. Honestly, at a glance, it's kind of hard to glean a pattern other than the fact that it seems that the home ownership percentage is lower in the West. But as they explain here, a lot of this clears up if you're looking at urban versus not urban counties.
Yeah.
So the urban ones have less home ownership, but honestly, I think there's something more to this here. And I think that there are a number of local and regional aspects that might be correlated with home ownership. For instance, there's a county in the southern part of North Dakota that has much lower home ownership. That actually lines up with Standing Rock Indian Reservation. So there's like these external factors. There's like, well, why is that? Oh, no, that's the Indian reservation. And there could also be spotty data here and there. But again, factors outside of population density, things like income levels or maybe just like a local preference or attitude towards homeownership, lot size, typical lot size, zoning, the age and development, history of a place, timing and interest rate environments. There's a lot of factors, again, that can move this rate of home ownership up or down, but the map, I think, is a useful starting point.
A lot of red, yellow, and orange. It's like a heat map of the United States right now, man.
It's what I kind of getting back to is like, is there a city where it's like, oh yeah, they love owning homes there? I feel like that's like,
well, cities
probably not.
Cities are going to be more transient in nature. People are moving in, moving out, moving around. That you're going to have. It's easier to, it can be easier to live, I guess, in rural and urban on lower income. But there's more services in cities which attract folks of lower income because you can typically more services for the income demographic. And so you're going to see lower home ownership rate. But
my guess is that it's not like a local attitude, and I posited that as one factor. Maybe like if all else was controlled, a similar size city in the Midwest versus the West, is there going to be differences? Now, I think that it is all due to, I think it's probably the attitudes are shaped largely by the conditions. So like if it's the tax environment is higher in one versus the other, if there's all these things that are tied up in it. And I think this is important for apartment investors to know too, because if it's really great, if it's really easy to own a home in a certain, and there's high home ownership rate, then maybe you might think twice about investing in apartments in that county.
Yeah.
But a good starting point for this little map. And a good transition, I think, to this Harvard Joint Center for Housing Studies article, which is 8 short facts about investor activity in the single-family rental market. What I think is really notable about this is what they avoid, which is the narrative of corporations moving into town, buying up all the houses, and jacking up rent prices. Yes, they do note that single-family rental investment has increased, but it is kind of a market-specific thing. There's so much that can and should be researched here, and kind of how land availability and population density may or may not intersect with home ownership. Again, I'd love to know what is it that drives like a rental activity versus home ownership activity. But it's not the fact. It's not necessarily driven by investors. They're not really shaping this thing.
Yeah, the more information that comes out, the whole idea that corporate landlords are really buying up all the single family homes, and a lot of that is being disproven to being really, not moving the market the way that the media and some would like to portray.
And that's the first point that they have that really sets the tone is single family rentals have long been a substantial part of the rental stock. And I think it is an incredibly important function that's only getting more important in the current high interest rate environment as we're kind of like carving out a whole new group of people.
And actually, when the argument is that, these corporate landlords or investors or whatever, they're coming in and they're taking homes from homeowners that could live there and they're turning them into rentals. That is the opposite of gentrification.
Yeah.
And so the same people who are, are just so upset that someone is coming in and fixing a house up so someone could buy it, which is, comes down to, it's often a different, racial demographic that is coming into the neighborhood. And so there's frictions there of, coming into a neighborhood. Well, when you're taking a single family home that was owner occupied, turning it into a rental, you're doing the opposite, which is typically diverse. You're allowing folks of lower income to come into an area.
Yeah.
And, a recent report that came out, Jay Parsons wrote about it on a LinkedIn, ends up diversifying neighborhoods, racially and economically.
Yeah.
And so you can't, which one is it? No matter what you do, at the end of the day, people don't like people making money on it. The end conclusion is it's like there's a group of people out there that just don't think that there should be any profit in housing.
Yes.
And that it should be, basically nationalized, or basically it should be like a utility. Housing should just be a utility that just people have a place to live, which is never, it will never, we have sort of tried that of, large national like housing programs, and they ran to the ground. They're horrible. Like it's the same reason why we don't have the government, running food distribution and food supplies and saying that, because the argument is like, well, everyone needs a home. It's a right. Everyone needs a place to stay. I think as a society, we should say that everyone should have a place to stay. There's no right. You weren't born with a house that emerges. I mean, humanity lived for a long time without that type of shelter. But you can say the same thing about food.
We could build that country, but it doesn't exist yet.
Good luck.
Yeah.
But you could easily say, we need food and water, and we do have programs to provide, some basic, essential like nutrients, but it's not as though we are outlawing different restaurants. Where it's not like we're outlawing the steakhouse because their food's too expensive and it's making the other restaurants' food more expensive also. There's different preferences, and the idea that we would live in a society that there was not a diversity of options, and that you could not achieve your goals of living wherever you want to live in any type of place you want to live, if you can figure it out and if you can afford that, that's a sadder environment than the fact that not everyone has a place to live, which is horrible and sad. But the only solution they're suggesting is basically all live in the same type of housing. Let's all live in concrete
I think that
tenements, and then we'll all be the same, and everything will be fine, and we'll all get average. Everybody.
Yeah, there's shades, and that's why it's like there are shades of that impulse that underline a lot of the mainstream articles that are that talk about.
You're mad that somebody's making money.
Yeah, and that's exactly.
They are, not you.
And no, that's fine. I'm always mad that someone's making money and not me.
Exactly. They're making money. I'm not making money, and they're like, well, someone is getting wronged in this, and you're making money off of it.
Got to be me. Just one more point. I won't go through all eight of the points. But there is one. Number 4, investor activity is especially pronounced in Sunbelt markets with strong rent and population growth. They're following hot markets. I think it's worth noting here, and I forget what the specific source is, but I do remember some interesting research that showed investor presence following high rent growths rather than causing them. Basically, a lot of investors got in too late to see the full span of the run up in rents for some.
So you're saying, Matt, is they're watching or they're listening to the Gray Report. They're getting the newsletter, which is graycapitalllc.com/newsletter. They're getting the rent reports, and then they're making their decisions.
Yeah, and so
Indianapolis is so you're predicting the big call
right, yeah.
is indie cap rate compression.
And the upshot really, or why I'm saying this is that like they're not actively moving these markets. They're not moving in and making rent growth happen. They are reactive. They're reacting to what they see these hot markets, and they jump.
It's a little bit of a feedback loop though, because I think I agree, but then that they go into that market and they built a business plan that includes continued rent growth. Now maybe they don't get it, but they're going to push for it.
And then their eighth point, which will be the last point I'll cover here, is that these single family rentals, the supply is growing, the construction. So maybe rent growth does go up in some of these markets that people see, the hot markets that come in, rents still keep raising. Well, what else could happen there is that incentivizes people to build more homes in that area. And maybe they're specifically rental housing, but it could just be more homes, period. And I think that the growth in construction of single family and build to rent is worth it as an independent thing, not just as part of my point about people following hot markets.
Yeah,
that's a worthwhile trend to follow, because it really does seem like we're carving out an entire new population of renters of home associated people, whether they're owners or renters. There's this new thing that's not quite apartment life, not quite homeowner life, and it's meeting the specific needs of people that want a lot of of that lifestyle of the single family home.
Well, and it's really bringing single family rentals into, it's been an institutional asset class now for the last decade or so, especially, Blackstone, after the great financial crisis, coming and buying a ton of single family rentals, but it's all been piecemeal, buying the property here, there, we're going to pick a couple markets. We're going to just try to build as much mass in that market as possible, which really you can only achieve if you're huge scale, hundreds of units, in a market, 1,000 units in a market. But it's still hard to manage because you're scattered site. You got your maintenance people driving all around. You got, you have to have some sort of centralization of operations, which on an apartment community, you've got like a, clubhouse or a leasing center. You got an office. You've got that central point. But these scattered site single family home communities have been tough. Built to rent is the solution from an operational perspective and a management perspective to allow an institutional group to come in and just to really kind of repeat the process of this is how we're going to manage this community because it's right here. I can have my team on site right here at this asset. I can do one transaction, even though getting into BTR, it's often multiple transactions, rolling closings on the development side. But once they've been developed and stabilized, and there aren't that many stabilized built-to-rent communities that are being sold. They have been, but typically they're coming out of construction, they're building.
Really new thing. That's what it's not like newly invented, but it's like it's essentially new.
Yeah, that's a good way to put it. Yeah, it's exactly right. I mean, this graph goes back to 1974. There were around 10,000 single family rental starts. So that could have meant a single house somewhere that's meant to be a rental, which has been going on here and there. I think it was often maybe unintentional isn't the right word, but like they weren't thinking about, the build to rent. We're going to build a community. I think it was more, we're going to build individual single family homes. But I mean, really starting at 2014 and then again, really kind of 2020, just huge, rocket ship up where, in 2022, we delivered about 80,000 single family rentals.
Yeah.
Or as we started, that has maybe not delivered yet, going to be delivering soon.
Yeah. And that's why I'm thinking about, the factors. Is there where there's more space for build to rent? Is that where it's going to happen? You can look for a much larger footprint, and there's just
where's it affordable? Where's the demand?
Yeah.
And again, it's the demographic story of the late 20s, early mid 30s into early 40s who are starting a family. Household formation is really high right now because all the millennials are finally like, okay, fine, I'm gonna get married, I'm gonna have kids. Need it now. Let's get out of this apartment. Oh crap, I can't afford a mortgage. We want a house. And so it's consumers are going to be leading this, and it's following those demographics. And so it makes a ton of sense. I think it's a good business strategy to keep following the millennial demographic because they're entering, peak earning years, or the, largest, pop age demographic, outside of the baby boomers. I think they're larger than the baby boomers now. And, selling to millennials and baby boomers is the right strategy.
Yeah.
Kind of regardless of what business you're in. Not that Gen Z isn't coming and Gen X, but they're just smaller demographic groups. And if you're focused on your traditional just multifamily, that may not be as popular to the largest swath of population, and we could see occupancies go down in traditional multifamily and, get really tight and build to rent.
Yeah. Yeah.
Now that it's like, not everyone knows it's a thing too. It's like you either think of an apartment, or I'm going to rent a house somewhere like in just a random neighborhood, in the city, or duplex, or I'm going to buy a house. Those are my options.
It will be interesting to see the, how much of a discount you would get as a part of a built-to-rent community than a similar square footage if it's just a single family rental.
Do you think there would be a discount?
I think there should be,
because because a part of the planned community, it's like not the same.
Yeah, it's
but what if you have amenities?
Well,
what if like the community has like a pool and like a workout center and stuff like that, and grills?
No, that's a good point. I'm really more thinking of like, you could, all being equal, you can undercut the rents of a single family rental if you have less expenses because things are more efficient.
Yeah. If you're a man, just take the management. Like if you're an investor and I'm going to buy a single family rental, you want to have it managed by a third party, you're paying, a 10% property management fee. I've heard of even 15, and then plus, you're paying for everything else. The very hard to make money on the single family rentals with third party property management. People do, but it's a big drain. And we're charging on property management side closer to 3%, 3.5%. And so for large multifamily. And so same
crisscrossing a city trying to tag all those.
Think about all the time you're wasting paying these guys paying, for mileage and gas for driving around, where you could just have everybody in the same spot.
Take a golf cart around.
Take a golf cart. All right, Matt. Great set of reports.
Thank you.
Digging into some interesting topics. Make sure you leave us some comments. We'll get back to them next week. Comments? We're supposed to do it this week?
We can do it next week.
We're going to do it next week. So fill up the comments. We're going to hit all of them, get your responses. And again, make sure you're signed up for the Great Report newsletter. You can find that at greatcapitalllc.com/report. If you're a accredited investor, sign up for the Great Capital Investor Portal to see what we got going on over there, to make sure you are updated as soon as we have an awesome deal. And we've got some cool stuff we've been working on. So you're going to want to stay tuned and be in the loop on that. Again, accredited investors only. Appreciate you taking the time with us. Thanks, Matt.
Yeah.
It's a good one.
Thanks.
All right. See you guys later.